Hey everyone, excited to be back for this week's edition of Frequently Asked Questions for Commercial Real Estate. In today's video, what I want to do is talk about a concept that is very common within commercial real estate, and that is what's known as a 1031 exchange. So in this video, we're going to explain exactly what a 1031 exchange is and why it can be so beneficial to you as an investor. Now, before we dive into this video, I would greatly appreciate it if you can like and subscribe to this channel. It really helps with the YouTube algorithm and ensures more and more people can hear this message and learn about the many facets of commercial real estate. So now you've done that, go ahead and like and subscribe below. We'll go ahead and dive right into this episode. All right, so as you can see, I'm on my Loom account, which is a video sharing software. So I'm going to go ahead and share my screen on the 1031 exchange timeline. So, all right, so in this video, I want to explain to you what the step-by-step process is of identifying and then ultimately closing on your commercial property through a 1031 exchange. So what a 1031 exchange is, it's essentially a section within the U.S. tax code that allows for investors to exchange like-kind property for essentially saving taxes on the sale. Because what happens typically is when you sell a commercial property, in this case, there is a taxable event that takes place on the sale of the commercial property. And right now, long-term capital gains rate as of March of 2022, if you're in the upper tax bracket, is going to be 20%. So as you can imagine, if you were to sell a property you bought for $500,000 10 years later, and now it's worth $1 million. Once you sell that property for $1 million, you would be subject to capital gains on the $500,000 gain. So $500,000 times 20%, which is the long-term capital gains rate, is going to be essentially a $100,000 taxable liability on your part as it pertains to capital gains. And understandably, a lot of investors don't want to have to pay taxes on that amount if they can help it. So that's where this vehicle called the 1031 exchange comes into play. So as far as the timeline is concerned of the 1031 exchange, I have this graphic right here that kind of illustrates it. To start, you would sell your existing property, and that's when the clock starts on the timeline. The second part of the process is to identify a replacement property. Now, there's three ways to be able to identify, or three paths, I guess, you can take when it comes to the identification process. The first and probably the most common way of doing it is to identify 3 replacement properties with no upper limit on the value of those commercial properties. So let's say that you sell a $1 million property, a retail property, and you want to exchange, that property. You could essentially identify 3 properties, and it doesn't matter what the sum of their values are. The sum could be $3 million, it could be $5 million, it could be $20 million, it could be $100 million. There's no actual limit. The only caveat is you have to close on at least one of those properties within that 180-day timeline to be able to complete the exchange. Now, the second piece of the puzzle is that you could do the 95% rule. And what the 95% rule means is that you can close, you can identify as many properties as you want, but you have to close on 95% of them. And the sum of those values, or the sum of the total properties that you identify, there's no upper limit on what those values could be. So as in this example that we provided, you sell your $1 million property, and let's say you want to identify 20 properties. That's completely fine as long as you close on 19 of those properties before the 180-day timeline is complete. This is somewhat more common if you have a very large property and you want to diversify across multiple buildings to be able to, theoretically diversify your risk across different property types or whatever, right? So there are situations whereby this strategy could be effective for what you're trying to do, depending on what your goals are. And then finally, the third way of identifying properties is the 200% rule. Similar to the 95% rule, you can identify as many properties as you want. Now, the only caveat is that the total sum of the values of those properties cannot exceed 200% of what the relinquished property was. So if you sold a property for $1 million, the sum of the properties that you identify cannot exceed $2 million in this example. So, and again, you must close on at least one of those properties within that timeline of 180 days. So that kind of gives you an idea of what the 1031 exchange process looks like. These deadlines are very rigid. Sometimes people get close to the 45-day timeline and they want to know if they can extend the timeline. You cannot. The U.S. government is very strict about these rules. So, and this is where the pros and cons of the approach comes into play. Obviously, from a pro standpoint, it makes sense because you're going to be able to save money in capital gains taxes. And if you're talking about a large commercial sale, you're going to experience a pretty sizable taxable event when you actually sell the property. So if you can save $100,000 or $200,000 or maybe even more, depending on the size of the property and taxes, it may be wise for you to consider this approach. Now, the main con that I see with this approach is that a lot of people get down to the gun, essentially. So they can't identify, they don't find properties that they like within that 45-day timeline, and then they just pick a set of properties just to say, okay, let's pick these 3 properties, even though they're not, though they don't meet my criteria from a financial standpoint, but I just need to do it so I can save money in taxes. And so you start seeing a lot of situations whereby 1031 exchange buyers are held to the gun, and they're having to pay more than what they would normally want to pay for because they don't want to relinquish or not have the exchange go through. And so that's what's happening right now in this low interest rate environment. There's not a lot of properties out there from an investment standpoint. And so there's a lot of 1031 exchange money looking for places to be put. And so, that's causing issues for people who are looking to find good deals, but they're having to compete with 1031 exchange buyers who just want to put the money somewhere so they don't have to pay taxes. And there's other ways you can save an exchange if, it does go south for some reason. This is not the subject of this video, and you could probably find a lot of videos online that can kind of explain that process. But at least this gives you an idea of the 1031 exchange timeline and process. It can be an extremely powerful tool for you to be able to save a significant amount of money in taxes and then continue to leverage up and get into larger and larger properties. Now, if you're in the process of looking to do something similar, maybe you have a commercial property that you'd like to exchange into something else, feel free to give me a call. I'm a commercial agent in Louisville, Kentucky. Our market is very beneficial for investors for a lot of reasons. The primary reason is that we cash flow a lot better than other parts of the country. So if you have a underperforming quote unquote property in California or some of these other markets outside of the center of the country, the Midwest, I should say, it could be wise for you to consider selling those properties to be able to invest in assets that can cash flow a little bit better than what you'd see on the coast. So would be beneficial for you if you're looking to do something similar in the Louisville metro area. Feel free to give me a call. My number is 502-536-7315, or you can reach me via email at raphael@crisantigroup.com. Again, thank you all so much for tuning in. I hope you found this message valuable, and we'll see you all next time.